All right, so today is our last market outlook video of 2020 as Brandon and I normally take off the holiday week here between Christmas and New Year's. If things get a little dicey going into the end of this week, tomorrow, half day of trading, or next week, where there's 4 days of trading before New Year's Day on Friday, if there's any kind of crazy volatility in any of those days, which is highly unlikely, but if there is, then I'll hop on. I'll be around. We'll talk about it. Probably not early next week. I got a basketball tournament that I'm coaching at. But if things do get crazy, then I'll put something together while I'm down at that tournament. So just stay tuned for that. But otherwise, this will be our last one. There are no trading rooms as well for our subscribers as we take these weeks off, and then we'll get back together in January. So today's video is a little longer. It's kind of okay, what do we expect now in 2021, and how did we finish the year, and how do we expect we'll start off next year, and what kind of year will the markets have going in. So we'll talk a little bit of a preview in today's video, and what's kind of driving this recent strength and how that impacts the expectations for the first few months of next year. So let's go ahead and get started. Today is Wednesday, December the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're really tightening up here on the range on this little intermediate rally that we've been on off of this October 30th low point. The last week, we had a pretty significant day of volatility, obviously on Monday. But the last couple of days, kind of not very much of anything. And today, we were mostly bullish until the very, very end of the day drop that brought us down to the day's lows. But in the after hours right now, we've kind of recovered most of that. The intermediate posture is still strongly bullish. Market sentiment still rising. It's above almost to the 75th percentile now. The momentum line has dropped to the lower reversal zone, again giving us a bullish intermediate confirmation signal. The last one of those that we got was right here. Also included the near-term line below 50. This one doesn't, but the near-term line hasn't been above 50 for very long. It's only been above 50 for 7 days now, which is the low end of the normal range for the near-term line to be above 50. So I think we still could have the upper end of the range is 12 days. So we could still have kind of the near-term line stay above 50 for the next week, as we head into a half day tomorrow and then next Monday through Thursday. So we'll see, see if that ends up happening. That's what you would expect to see off of that price pattern. Obviously, we had some room to run up to last Friday's high point. Obviously, we gapped down on Monday, but last Friday's high is the high of the all-time high. For the S&P 500. We still have some movement to get up there before we get a new high. Otherwise, we've been kind of trending really sideways and starting to lose the trend strength that we have right now in the SPX. If you look at the trend strength indicator here, SPX, you'll see that we have that we're dropping down to 3.6. We're dropping down slightly to 78, and we'll see if this breaks down. You'll probably need to see this red line break down to below price, or get down about where price is before you start to really break down in the actually it would have been over here. This would have been this price. The red line breaking down below price is usually by the time you get the end of the trend. So that's not very far, and that would be down to, we'd be looking, by the next week, we'd be looking for a move down to about 35.62 for that to happen, if that were to occur. So if we take a look at where that 35.62 is on the chart itself, that would be a 35.62 would be right in this area. So it'd still be above the 38% retracement. Which is, again, if you're going to get an intermediate pullback, you're going to drop below the 30-day moving average significantly. Right now it's, easily up above the 23% retracement level. So if we were to get to the 38, we'd be well below. So intermediate drop for sure. And that's down to 35.40. So And that would be a pretty decent intermediate drop if we were to get that. You can see the Russell 2000's really blown up and it's finishing the week really strong. In fact, if you take a look at the weekly candles for these, for the SPX, again, strong bullish posture, just like the daily, almost like very much like the daily chart. But if you look at the Russell, the near-term line's been up high. We've already have a cluster here, and look at, we've had 1, 2, 3, 4, 5, 6, 7, 8 consecutive bullish weeks on the Russell 2000, which is actually what that's done is it's produced a monthly cluster on this December. Now we're not done yet, and the momentum line is just barely above the 80th percentile. So we might not finish the month. We still have a half day tomorrow and another 4 days next week. So if we come off of that monthly high, we're sitting the highest 2011, we're at 2007. So if we come significantly off that high, then we probably won't end up with that cluster by the time all is said and done. But to get a cluster here, this 2-month extreme move, that's a pretty significant move. In fact, if you take a look here at how far above the 40-week exponential moving average we are right now, we are in the highest level of the past 10 years, the highest level of the past 20 years, and you can see some other instances of being relatively bullish with an overbought cluster on the market forecast and all of these. You can see some other instances over here. But if you were to go back, not very much more, but to as much of the data that we have on this chart, there's only been one other period that we've been higher above the 40-week exponential moving average than we are right now, and that is back in February of 2000. That's how high above, 32% up above with a cluster here, among many other extreme indicators that we've seen. I showed you before the directional movement index, the ADX getting up above 45. The positive index hit above 40 on the Pfizer news and the Biden Pennsylvania news. The negative directional index got down here below 10 and has been below 10 for a while. Again, just to give you an idea, these purple arrows are when we get the negative index down there. You can see, back in October 2017, we had some arrows there for a while. You can see back over here, and this would be October or January 2013. We had some arrows here for a while. Same thing in 2012, and then briefly over here in 2010. But again, you look at the ADX getting above 40, and we didn't get above 40 here in 2016 coming off of the election. All these other times that we got above 40, here we didn't get above 45, and we were pretty strongly bullish there too. That led into a period of volatility. And then over here we barely got above 40. So it's pretty rare for the ADX to get high on a bullish move. We did get up to almost 50 or over 50 in 2004 coming off of that low point, this intermediate pullback there. That brought it up. This also brought it up, and you can see the up and down moves that we have when the ADX, the average directional index, gets this high and starts to peak out. You can see something very similar on the Bollinger Bands right now. The Bollinger Bands here, if you take a look at the band width and how high the band width has been, if I were to go back 20 years, just for some perspective here on this jump where my cursor is, you can see, we've been up here. We got up this high in the bandwidth on the June parabolic move. And then, again, you go back over here to 2016 at the very end, very, very similar. And our bandwidth is starting to fall. But even at current levels, the bandwidth, outside of other spikes, the bandwidth is still pretty high. And of course, you can see over the last, 10 year, 20 years, not very much volume in this area at all the way down to that 78% retracement of this COVID low point. If we were to move this around, so remove this drawing And instead, here, let me just make sure I have the snap over here. If I were instead to draw lines, Fibonacci lines, from this low point here all the way up to what's the current high point, then you can see that the 23% retracement would be down to filling in this basically no volume level, and then the 38% retracement to the pre-November highs. In fact, I kind of mentioned that in my class today, that this move, this 38% drop, which would be about a 20% drop on the Russell, would be equivalent to that same level pre-election, to equivalent to a 23% drop in the NASDAQ and the S&P, just a little more than 10%. So if we were to get that type of move, that would most likely mean, here is this one, that would most likely mean that we are headed towards, sorry here, most likely mean that we are headed for a bounce in this index. You know, we are coming down, we've dipped below 40, we've dipped below 40 before, especially coming off of that November cycle, that November election. Very similar type move here that we're getting then, and then we rallied, the Qs rallied into a really bullish year, and that's the kind of year I expect that we'll get in 2021, especially again with the histogram here flattening out, which means that this decline, this sharp decline that we're getting in MACD and PPO, or it's starting to moderate and slow down itself. So we'll see kind of what these weekly candles end up looking like by the time they do turn back around to the upside, and see if this RSI gets right back above 40 just like that, and gets up towards the upper end of the bullish range. Obviously 40 would be the lower end of a bullish range. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again. It's a quick way to give us feedback. Of course, if you don't like our videos, you don't have to click on anything. But if you do like our videos and want to let us know, you can click that thumbs up right now even while you're watching. It's a big deal for us. We check that out every time. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. My handle here at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog here, I do invite you to check out our other products that we have, including our Market Outlook live video. This is for all of our premium and our plus subscribers. We review all the old trade ideas we've done in Market Outlook videos. We manage the trades all the way up to the time that we close them. So every time I do one of these, I do a live video at 3:30 Eastern time on YouTube, YouTube Live, and like I said, we check out all of our trades there. And continue to manage them. Also, our trading rooms are listed here in our events calendar. You can also get to those up here at trading rooms. You can see after tomorrow's class at 11 a.m. Eastern, it's my last class of the year. Then Brandon and I are both off until New Year's. So our next class will be on January the 4th. Also, if you come down here, click on this heart. It opens up a new window where you can click on this like button right there. Also click on this thumbs up, also opens up a new tab. You can click this like button there. Again, the more you do that, the more people our posts will reach, right? They'll get to all of our followers and not just literally a handful of our followers, because of the comments and engagements it has, likes that it has. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. Alright, now let's take a look at some of these other charts, the 3 green arrow charts in particular. Obviously very small range today, well below the average, very small volume. That's very typical this time of year. We're going to get that now. If you look at the 2-line version, you can see how the MACD and stochastics are still just dropping. So we're not dropping here, but we are starting to consolidate, and we'll see again how we do towards that 17-day moving average. Whether or not we'll break down through that or whether we'll bounce back above the 8-day moving average, having broken down below it here. I did mention today that our 1-year chart's at 14.4%. It's been an interesting year because if you take a look at like linear regression here, you'll see that going into, like say for the 10-year chart here, going into 2018, going into 2019, excuse me, if I take a look at the 10 years going into 2019, so that would be from 2001, and this would be going into 31 of 2018. Sorry. So if I come over here to 2018, and then it would be actually 1999. Go to a weekly chart. You can see that. Oh, excuse me. Sorry, that's not 10 years. It'd be 2009. There we go. So you can see that we had our low point. Like we had set the bar low, and going into 2018, we were down below 1 standard deviation. That that we ended up with like a 27% return. And you also look too at the VIX for the same time frame here. Let's come over here and take a look at the VIX going into 2019. And you can see that, okay, well, the VIX was right around, we had been up in the 20s, and by the time we ended the year, we were at 21. So we were just above 20, just like we are right now, but we were at the bottom end of this linear regression trend line that we're seeing here, right? At the bottom end of this. So fast forward 1 year later to 2019, and you can see, okay, well, we were above the 1 standard deviation channel going into that year. And if you look at the volatility index for the same time frame, for going into 2020, we were well below 15. So as a result, we ended up, like I said, with a 15% return. We were at the upper end of this, 27% return here going into 2019, and a 15% return as of right now going into 2020. Well, now we've kind of got both. We are in the low 20s on the VIX, sets us up for a decent return, but instead of being at the bottom end of this linear regression channel for the 10-year period, we are actually at here, go to 10 years weekly, we are actually at the upper end again, right about the 1 standard deviation. In fact, if you look at the 20-year time frame, it's even worse than that. In the 20-year, we are above the 2nd standard deviation channel. So again, it's almost like COVID's not an issue. We are on pace. Now the 20-year pace includes 2 recessions, but we continue to be on pace for like as if COVID never really happened, and the markets has priced in the fact that the economy will get back to its pace as if, again, COVID never happened. In fact, not only as if COVID didn't happen, but as if we have fully recovered and then are now growing again at really strong levels. Obviously, we're not there yet, but the market's ready for that. That's priced in the inevitability of that happening. That's why we're so far up above here. And again, we saw in 2019 that when you were this bullish, that typically, that especially with a low VIX at the time, it led to about a 15% annualized return versus a 27%. So we're probably going to get somewhere in the middle, but more than likely we'll start off the year with some weakness, because that brings me up to this chart that I wanted to show you. Nope, not that one. It'd be this one. If you look at this chart, this is the rate of change down here for the full year, and you can see the Nasdaq's at 45%. Look at the Russell 2000. It's currently at 19%. But that's based off of a cost basis that's right about in this area, right? 1224, or right about there. So you can see, looking at this number over here, you can see that my return is roughly right around 20%, right? That's what we'll end up with. But what's interesting is if we don't go anywhere, we don't go up or down, if we stay right around 2000, by the time we get to March expiration, which is where this low point is, so if we don't go anywhere between now and then this rate of change is going to spike up over 100%. So down here at the bottom, that rate of change, which right now is at 20%, the highest level that we've gotten to here recently is up here right around 45%. And again, you can see the biggest level, one of the biggest levels, we got to 83% coming off of that very significant low point in 09. So that significant drop in March of 09 set us up for, by the time we got to March 9th of 2010, set us up for about a 95% rally on a 1 year basis. And then again, same thing here, when we were at this low point in March of 03, well, by the time we got to March of 2004, we were up to about 67%. So to get to 100%, again, would mean that between now and March, we'll have a flat move. Otherwise, if we keep going up between now and March expiration, then we will have an even bigger, like right now we're only at 19%. We'll have an even bigger number as the cost basis here for this rate of change drops down to these lows. And if we fall back down, then we'll get to that point where we'll have about an 80%. In fact, if you say, okay, well, what if we pull back between now and March expiration? What if we pull back to the 38% level? Well, that would be a 63% 1 year return by March expiration. If we pull down to the 23%, that would be a 78% return. So you can see even those numbers would still be a lot higher than where they are now, and still would be relatively high considering that, absent a significant bear market, which we haven't been in, again, that number got into the 40 or 30s. This number got into the 40s. A 60% number would be a very similar number to, really we don't have an equivalent. We'd have to go back to, this 2012 coming off of this low point there. We were at 37%. So, absent a significant bear market, you can see the 2016, as I mentioned, got up to the 40%, 45%. This would be 100% if we got to March expiration. So that was our cost basis for a 1 year return. If we got to March expiration without any movement from here, we'd be at 100% down there. Again, without that being a significant, like a major market meltdown low point, where we were in death cross environments for an extended period of time, we basically just dropped right down, bounced right back up, and then some. And the Russell 2000 finally, since the election, catching up with 2 extreme months of returns. All right, and as I said before, today's range was very, very small. Here's what it looks like here. The 4-week range is really tightening up considerably. Keep in mind that the actual high point was not this 378.46. It was over here at 372.46. 372.46 is the high of the 4-week period. The low being 359. That's one of the tightest ranges we've seen in a while. Typically, once you start to get under 5%, you're starting to tighten up a little bit. And so you can see here, 372.46 minus the 359.17 is a 13-point range out of the 372.46. We're well below the 5% mark. So very, very tight range. It's going to tighten up even more as we get through the Christmas holiday. We'll get these days off. The low point's actually going to end up being right there. So that's a pretty significant change in the range from what it was. If you go out to like a 90-day chart here, you can see how the range was pretty wide before it started to tighten up here. So that's just a sign that we're kind of anticipating some kind of a breakout of a really flat range. You can also see too, this goes back to 11.25.20. So if I go to the market forecast and come up here, 11.25.20 is right there. So once we get through the holidays, it'll be this kind of tight range, which you can see again is very tight compared to what it was. It was a pretty wide range there, some ups and downs before that move. So now again, whether or not it's a breakout to the upside or breakout to the downside remains to be seen. Obviously, there's a lot of extremes right now, so any upside breakout would be very limited. And any downside breakout basically would be kind of a deeper exhale on a Fibonacci level on a percentage basis than it would be than what we had here. Maybe on an absolute basis it might not be as big, but on a relative basis, I mean, that was only a 23% decline. As of right now, we could drop all the way down here to this 33 level, which would be well through the retracement zone of this current intermediate run, and still not be a market sentiment pullback, which I don't think that we'll get on any weakness here for a while as a market sentiment pullback. Of course, if we were going to get one, the unlikely scenario that we were, that would mean our VIX is breaking up to 115%, and that doesn't look likely anytime soon either. In fact, just getting above to 100% will be a significant deal, again, on any kind of weakness. We saw that early September. We didn't even get to 100% in early September. It wasn't until that late October 30th low point, that we finally got up to the 105% mark on a closing basis, which is what matters. And then eventually breaking back down as we bounced off that October 30th low point. So today's volume and trading range were very small, and you'll see they're going to continue to get relatively small. Take this bump with a grain of salt there, because again, remember, the range was actually the high is actually a lot less than 378. In fact, if you look at SPX instead, which we don't have the volume associated, but if you look at the range for SPX, we're flirting with the 1% mark, but we've been coming down ever since. And you can see this daily percent price moves and this wide gap between, again, it gets the widest before we peak. And then you can see historical volatility. Usually we ramp up, and then historical volatility really starts to catch up pretty quickly until they cross over. In this case, cross over, and that's where the low point ends up being set in. But as of right now, we're not getting very significant closes, and we're not getting very many significant gaps here, which if we're going to get this intermediate pullback, as you can see here in September, we usually start with a pretty decent sized gap, at least a 1 standard deviation gap to the downside that we haven't gotten here for quite a while. All right, so to summarize the outlook here going into the end of the year, obviously we're setting the bar very high for 2021. We're setting the cost basis very high, which means the expectations for a return in 2021 by the end of the year are probably not going to be so high. That doesn't mean we won't have a good bullish move in 2021. It just means that probably the beginning of the year we'll see some weakness that will set the bar a lot lower to have a good 20-25% move off of that low point by the end of the year. But up into that low point, we could start off with some kind of drop, 10%, 20% on the Russell, because it's gone up a lot more. And we saw the Russell really underperform in June, coming off of its June peak. So there's definitely precedent for that before. And we also saw the outperformance that the Qs took coming out of December of 2016, coming out of the election. The last time we had, this overbought monthly cluster on the Russell 2000. So, how's that weakness going to look? When's it going to start? Most likely won't start next week. It most likely going to be pretty quiet next week. Most likely we'll start the year relatively, but at some point in time, and probably post-January expiration, there'll be some kind of catalyst where, all the buying will have been pulled forward, right, in anticipation of the vaccine and the stimulus. And now we have all that. There's no more buying left because we pulled it all forward to build the expectations for this. That will most likely there'll probably be some kind of catalyst that will exacerbate that environment for selling to occur. Again, not bear market selling, just exhale selling. We've been so bullish now, and most likely won't start until probably post January expiration. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you seeing that suggests either whether you may be a lot more bullish than I am, going in for great returns in 2021 without the need for an exhale, or you're a lot more bearish than I am, that the exhale will be more of bear market selling instead. So let me know what you're seeing that drives that opinion down in the comment section below. All right, now let's take a look at how the different asset classes are performing. You can see the really good returns, especially off that October 30th low. That's when there's been a lot of separation between small caps and the Qs. The Qs really only up about 16% coming off of that September 24th low. And that's actually the 3-month return right now. But that's actually the, if you look at where the low points occurred, in September, it was right there on the 23rd. So this last 3 months here actually does go from the 24th on up, and again, small cap in 3 months, small caps are up 38%. The S&P is up 14. I mean, those are good returns in itself, and to be more than double, just about almost triple on IWM over SPY. Is significant outpacing, and we all know that that's the reason why you see like this move in relative strength down, and it did come down below the 200-day moving average, but you notice the MACD histogram is slowing down, the PPO is slowing down, it's gone negative, the 50-day is just barely below the 200, but the initial surge, and now we're kind of slowing down the descent a little bit here. And we'll see kind of how that plays out in terms of what kind of weakness we when and how we get what kind of weakness here. And you can see going into this week that we have so far, small caps are up 2% for the week, and the S&P is actually down for the week, and gold is down, bonds are up. They were up going into today along with the dollar, but so are small caps. So it's and with everything else, with the dollar dropping today and bonds dropping today, small caps maintained their rally today. As you can see, safe havens, but again, by the end of the day, even the Qs ended up being down today, and the S&P ended up being relatively flat. So the late kind of sell off, but is having its impact. If you see how what's going on with the Euro US dollar, we talked about 20-year linear regression. Well, the Euro US dollar is just barely making a run towards its linear regression from being below it, and has room now to oscillate up to the upper half. So obviously weakness in the dollar, so strength in the euro would be very significant. And then of course looking at TLT over the last 20 years, again, we've been bullish going into the beginning of this year. We were kind of on pace, but then really took off. Going into 2019, we were well below the pace. So at the end of 2018, again, when bonds had kind of, we had that fourth quarter decline, bonds were really weak going into that. In fact, this is what it looked like. Here we'll go to 2018 here. So yeah, 2018, and we'll go to the 31st of 2018. Then we'll go 2000 would be 19 years. So let's go as far back as we can. I don't think there is a 1999, but yeah, we only can go back to 2002. But you can see going into 2019, we were pretty oversold on bonds. And even though stocks rallied in 2019, so did long-term bonds. But as you can tell now, that's not necessarily the case anymore. We're not setting ourselves up a low bar to raise. We're actually at the higher end of things, which means a good chance that throughout 2021 bonds come back down towards their pace, the linear regression trend line, and then some. If I take a different look and look at the 10-year linear regression, you can see a very similar pace that we have going on. Even if the 1-year linear regression means we're finally breaking down to the lower end of the channel. So we're finally getting some weakness there. You'll see kind of flirting with that 200-day moving average, and we're flirting with an over across of the 50-day moving average crossing the 200-day moving average, with the index itself showing some weakness as we're flirting with the 200-day moving average itself. And again, we have this rally here all the way up to the COVID high point. Even if you don't use that, if you activate this and use more of an not such a crazy high, but more of you can see a double top in this area, then we're flirting with that 23% retracement level, which means we're on pullback mode now. We're going to head towards the 38%, if not, I believe we'll probably end up getting 50 to 62% retracement by the time all is said and done on this current market sentiment pullback that we're on right now. You can see other safe haven assets like gold doing something very similar. It looks almost exactly the same chart there, and if you look at its linear regression over long time frames as well, where'd it go? There. And pull up linear regression for gold, and then let's go out that same kind of 20-year time frame here. You can see again we're still above a positive pace. We weren't so bullish earlier, but now we are. And we're making our way back down. And again, weakness in the dollar might actually keep this up in the upper half of the bandwidth. Just don't expect it to outpace stocks. In fact, if you look at the relative strength here of gold to stocks, to the S&P 500 in particular, you can take a look. That even though gold itself is still relatively high on an absolute basis, especially compared to 2011, if you go back to this chart here, there's your 2011 high point. You can see we're actually, if you follow the horizontal line over, that's about where we're at right now, even with the pullback. That's about where we're at right now on gold. So if you look at that, this is where we're at on the absolute basis. We're nowhere near that on a relative basis. So gold is still very oversold relative to stocks, and you expect that would continue to be the case. Even with the dollar, with the dollar bearish, gold will rally, but we expect stocks to rally even more. And if you carry this further to emerging market stocks, then you can see, okay, again, there's that 2011 peak in gold. And you can see we're not nearly as oversold in gold relative to emerging market stocks. So there's an opportunity for more of a breakdown here in this area. It looks like we might have a little bit of a jump higher again on any kind of intermediate weakness over the course of the first few months of the year. But then I expect that we'll make our way back down towards some of these levels here. That's where the market peaked on stocks versus bonds for emerging markets, at least. Remember, in October 2007, and you can see the rally there. If I look at the same thing for stocks and see where we peaked on this or bottomed out on this ratio in 2007, it was earlier in 2007 where we peaked, and we made that long run. So we're actually lower now than we were then. So stocks are even more overbought now versus gold than they were in then. And if you look at where we are relative to long-term bonds now versus where we were in the bottom of 2007, we're lower now than we were then too. So as bullish as we were in 2007 going into the financial crisis, we're even more bullish now on equities. That doesn't necessarily mean we're going to drop 50% like we did in 2007-08. We're not having a big financial bubble bursting. But this again shows from a valuation perspective just how bullish we are. This chart here shows us the valuations. And if you look at here just USA, and here we are in 2007, the peaks in 2007 for the CAPE ratio, we were in the mid to high 20s, coming off of some high 40s in the 2000s, but we were relatively large here. And then you can see now we are actually a lot higher now at 34 than we were when the market peaked in 07. So as bullish as we were then, in fact, going into early 2018 when we really peaked and we started kind of this bear market, I told you, this fake bear market in international stocks especially. If you look at like China's, here in early 2018, you can see a lot more of a drop in valuations in China down the mid-teens. And if you look at Europe, we started down too we were in the low 20s, and we stayed in the low 20s, and eventually got down to the teens during the COVID low point. So you can see more of a valuation compression in these international equities, and you can see everything's rising, but there's a lot more room to go up in these international areas, more so than what we're already up in the U.S. area. So of course, ultimately that's going to mean that we have opportunity here. If I can get my cursor to come over here and take a look at international relative, and you can again see we're way down and lots of room to grow into 2021 and beyond for international stocks to more than outpace U.S. equities. All right, if you take a look at the sector rotation, you can see our sector, this is on a weekly chart, mind you, but the sectors with the biggest strength right now continues to be, the biggest momentum, it continues to be energy by far. It's got very, very strong momentum right now. Financials has relatively strong momentum, stronger than any others. And you can see communication services really ramping up. On the other end, you can see some of the worst negative momentum we got is staples, utilities, and real estate. So really significant drop in the safe haven sectors. We're also seeing some pretty negative momentum in industrials and materials. So the other kind of half of this small sector areas, of course, technology and discretionary look like they're starting to ramp slowly back up and follow the same trend line technology is looking for. So, as we get some rollover in these smaller sectors, kind of look for the weakness in these areas, which have been so bullish to get to this point. You can see, again, the strength was in utilities and industrials and financials and energy, and you can see your safe havens are rolling up in energy, but now everything is kind of rolling over here, and I expect that to lead to some weakness as what was the strength is rolling to the downside, and then some of this cyclical areas will eventually roll their way back up and then continue to retake the mantle of leadership from the smaller sectors and lead a new market move higher. But again, when and how that's going to start in 2021 obviously remains to be seen. Here's this chart. When you look at, I showed you the 3-month chart for coming off of that low point, off that September 24th low point, or 23rd low point. You can see energy and financials are your two big winners. Industrials, materials up there too. Technology has had a good run here of late. Everything and communication services is kind of holding up. Your safe havens area is lagging behind only 5%, whereas energy is up 26 and financials up 25. So really strong returns in areas that had just been so weak, right? Especially going in, if I go back a couple of years here, going into this the COVID lows. In fact, if I do a 1-year return, where was that? It was March 23rd. So if I do a 1-year return at the March 23rd lows, which was a pretty significant negative return. Here, let's go to 19. You can see, again, the S&P was down 20% at that low point on a 1-year basis after being up 20%. You can see the biggest losers, industrials and energy. Energy down 64% in that year. Industrials were down 33%, and financials were down about 30%. So big losses in those areas. And now, off of that low point, they just happen to be the biggest winners, right? So coming over here to 324, going forward to today here, they just happen to be some of our biggest winners, and they're playing catch up. Industrials is doing well. Financials and energy are basically catching up. Even as of September the 23rd, at that low point, they were still relatively weak performers off of that low. Energy had a nice good rally initially, up about 97% off that March low point. They were down so much. Financials, industrials, materials peaking there in June. That was the first parabolic move, and you can see now here's the latest parabolic move especially coming off this 1028 low where energy is really taken off and financials is really taken off and caught up to some of the underperformance that they had, at least up into that point. All right, that brings us to our trade idea of the day. Again, I've already placed this in the Market Outlook Live trade review video, but if you take a look, we looked at Caterpillar. You can see the rally we've had in the after hours here. But if you look at Caterpillar, it's been a very sideways trending stock itself. It has been relatively bullish. Of course, it's been slowing down. We got light pink shading right now. The intermediate line's crossing below its market sentiment line. You can see from a 3 green arrow standpoint, just like the broader market, the MACD and stochastics are both dropping. The market, the stock itself doesn't have to drop significantly, especially with the stock itself kind of hovering around a pretty good volume node here. So it's not going to be necessarily easy for it to fall. And you can also see we're well above the cloud. We still have maintain a pretty strong trend, and we're holding that blue line for support. We got room that we could drop and still stay above the cloud as we head into a January expiration, and again that red line's above the price. So we'll see how this plays out. But you got a good, decently strong move. We just are running out. The ADX is rolling over. The bandwidth has come down. I didn't show you that, but the Bollinger bandwidth is down to really low levels. So I expect that we'll kind of just trade sideways here. Of course, what does that mean? That means that we want to trade a bull put spread and a bear call spread. So I'll sell at the 20 deltas. We'll sell the 190, and we'll go up to the 170 in this case. Buy the 167.5, buy the 192.5 for protection. So there's my trade there, and we'll position size around a full position because we don't have to worry about earnings before January expiration. Comes out after, so we can get a pretty decent return for a full position on this trade as long as it stays within these blue bands, right? Again, to the upside we have a little bit of a risk. To the downside we have a little bit more risk by January expiration. But the benefit we have to the downside is, we have multiple layers of support up above that level. By January expiration, it won't be impossible to break down below it, but it will be more difficult. It'll be easier for it to actually go up and potentially get up to 192. And remember, even if the markets are bullish heading into January expiration, we don't expect it to be very, very bullish. We expect it to be more muted and see more sideways, which makes this type of strategy perfect for the conditions that we're in right now on stocks that have been bullish but are kind of moderating, that are at least consolidating in a sideways action at their worst. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. You can open up any new thread there. Any free subscribers, free our monthly and our premium, we can all participate in the forums. The point is to keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Give us a like on YouTube, as well as a thumbs up on YouTube, as well as a like on Twitter and Facebook. Comment on the video. Have a great rest of your weekend, everybody. Have a great Christmas and a Merry Christmas to you and your families. And thank you very much for a great 2020. From our perspective here, our community continues to grow. It grew even more this year than it did last year. So it's a great benefit for us. And we look forward to an even better 2021 going forward into a new year. So thanks again. Have a great one. This will be our last Market Outlook video until January the 4th, until after the new year. Unless things get a little wacky, then I'll step in and do a little update. But this will be our last outlook for the year, for 2020. And we'll see everybody in 2021. All right, thanks everyone.